Most people think banks make money the same way any business does. They charge fees, they invest, they skim a little off the top. That's comforting because it sounds simple and controllable. But that's not the real story. The real story is quieter, more mechanical, and once you see it, it's hard to unsee. Because banks don't make money by working harder, they make money by sitting in the middle of a system you can't opt out of. Let's slow this down. Right now, somewhere in the world, someone deposits $1,000 into a bank. They feel responsible, safe, maybe even proud. That money feels like it's just sitting there. It's not. The moment it enters the bank, it changes identity. Here's why this matters right now. Inflation is high. Interest rates are high. Household debt is at record levels. And banks? They're reporting some of the largest profits in history. Same system, different outcome. So how does that happen? It starts with a strange idea that most people never question. When you deposit money in a bank, it is no longer your money. Legally, it becomes the bank's money. What you get in return is a promise, a liability on their balance sheet. That sounds abstract, but it changes everything. Because the bank doesn't store your money in a vault waiting for you to come back. It uses it. Let's say a bank has $1 million in deposits. You might assume they lend out maybe half or keep most of it safe. In reality, they're only required to keep a small fraction as reserves, sometimes 10%, sometimes less, sometimes effectively zero. The rest? It gets loaned out. Mortgages, car loans, credit cards, business loans. And here's the first uncomfortable detail. The bank is lending money that already belongs to someone else and charging interest on it. If they lend out $900,000 at, say, 6% interest, that's $54,000 a year. Where does that money come from? From the borrower. Where did the original money come from? Depositors. The bank's contribution? Permission, paperwork, and time. This is where people usually say, well, banks take risk. True, but watch how the risk is structured. If borrowers pay back their loans, the bank collects interest. If borrowers don't pay back their loans, the bank still has claims on assets, homes, cars, businesses. And if things go really wrong, history tells us what happens next. Emergency lending, government guarantees, bailouts. Losses get socialized. Profits stay private. That's not a conspiracy, it's a design choice. Now let's talk about interest, because this is where the system quietly accelerates. When interest rates go up, most people feel pressure. Higher mortgage payments, more expensive credit cards, harder borrowing. Banks feel something else: expansion. Why? Because banks don't earn interest on one loan. They earn interest on layers of money created through lending. Every new loan creates new deposits somewhere else in the system, which can then be lent again and again. Money multiplies. Debt compounds. The bank earns interest at every layer. This is why rate hikes hurt households faster than they hurt banks, and why tightening the economy doesn't mean what most people think it means. Then there are fees. Overdraft fees, account maintenance fees, late payment fees, transaction fees. Individually, they look small, annoying, but manageable. Collectively, they generate billions. The irony is subtle. Fees exist to manage behavior, but they are most profitable when behavior doesn't improve. A system designed to penalize instability depends on instability to grow. And that brings us to credit cards, probably the most efficient money printing machine banks have ever built. Credit cards don't just charge interest, they charge confusion. Variable rates, grace periods, minimum payments that feel helpful but mathematically trap you. Paying only the minimum isn't a mistake, it's an invitation. At 20% interest, a balance doesn't need to grow fast to last decades. Time does the work, and the bank gets paid for patience. Now zoom out. Banks don't just lend money, they influence where money goes. What gets built, what gets funded, what gets delayed. Entire industries rise or fall based on credit availability, and yet banks rarely create value in the way most people define value. They don't build houses. They don't produce goods. They don't invent technology. They allocate access. They sit at the valve and charge rent on the flow. This is where hype and reality diverge. The hype says banks support the economy, that they enable growth. The reality is more neutral. Banks optimize for profit within the rules they're given. If debt expansion is rewarded, they expand debt. If asset inflation is rewarded, they inflate assets. They don't ask whether the system is stable, only whether it's legal. Which leads to the quiet risk no one likes to talk about. A system where money is created as debt requires more debt tomorrow to function today, not more productivity, not more efficiency, more borrowing. That works until it doesn't, and when it stops working, the question isn't whether banks survive. History suggests they usually do. The question is who absorbs the adjustment. Higher taxes, lower purchasing power, frozen credit, lost time. So here's the uncomfortable thought to sit with. Banks don't make money because people are bad with finances. They make money because the system works best when money is scarce for some and abundant for others. The system doesn't need you to fail. It just needs you to participate. And that raises a final question worth thinking about. If the most profitable institutions in the economy make money by controlling access to money itself, what happens when trust in that system starts to erode? Not tomorrow, not dramatically, just quietly.